What if I told you part of your monthly payment is not your money, never touches your bank account, and is quietly held by someone else for bills you haven't even received yet? No, this isn't a scam. It's called escrow. And if you have a mortgage or plan to, escrow decides whether your payment stays predictable or suddenly explodes without warning. Today, I'll explain escrow so clearly you'll never look at your monthly payment the same way again. No jargon, no legal talk. Just how taxes and insurance hide inside your payment. Let's strip this down. Escrow is a holding account. That's it. Your lender takes extra money from you every month, parks it in a separate account, and later uses it to pay property taxes and home insurance on your behalf. Why? Because your lender cares about their money. If taxes go unpaid, the government can seize the home. If insurance lapses and the house burns down, the collateral is gone. Escrow protects the lender first, and you second. Most people think, my mortgage payment is my mortgage payment. Wrong. Your payment is actually 3 payments disguised as one. The loan payment, principal plus interest. Property taxes, collected monthly. And home insurance, also collected monthly. Escrow is the bucket that holds taxes and insurance. So when you pay $3,000 a month, maybe only $2,100 is the loan. The rest is not yours anymore. Here's the psychological trap. You pay taxes once or twice a year, but escrow charges you every month. That mismatch makes people think, why am I paying taxes when the bill isn't due? Because escrow works forward, not backward. It's pre-funding future bills, like saving for Christmas all year, instead of maxing your credit card in December. Now let's walk through how escrow actually works step by step. Assume your annual property tax is $6,000. Your annual insurance is $1,200. That's $7,200 per year. Divide that by 12. That's $600 per month. Every month, you pay your loan amount plus $600 into escrow. When the tax bill arrives, the lender pays it. When insurance renews, the lender pays it. You never see the bill. You never miss a deadline. That's escrow doing its job. Now here's the part nobody explains. The escrow cushion. Lenders don't just collect exactly what's needed. They also keep a buffer, called an escrow cushion, usually up to 2 months of extra escrow funds. Why? Because taxes rise, insurance premiums jump, and lenders hate surprises. So your escrow balance always looks too high, on purpose. This is legal, regulated, and extremely misunderstood. Ever heard someone say, my mortgage payment randomly went up? It didn't. Your escrow was recalculated. If property taxes increased, insurance premiums rose, or last year's estimate was short, then escrow adjusts. It raises your monthly payment and sometimes adds a catch-up amount. Same loan, same interest rate, different escrow math. Now there are 2 possible outcomes. An escrow shortage, where there isn't enough money to cover bills and your payment increases. Or an escrow overage, where too much money was collected and you get a refund or lower future payments. Refunds feel nice, but they often signal bad forecasting. Stable escrow beats surprise checks. So can you avoid escrow? Sometimes, yes. Usually, if you put 20% or more down, have strong credit, and request an escrow waiver. But be careful. No escrow means you must save for taxes yourself You must pay insurance on time, and you absorb all timing risk. Escrow isn't evil. It's forced discipline. Here's the final takeaway. Escrow is not extra money. It's not a fee. And it's not optional for most borrowers. It's simply taxes and insurance, hidden inside your payment. Once you understand that, you stop fearing payment changes, you read statements differently, and you actually control your housing costs. If this finally made escrow click, you're ahead of 90% of homeowners.